Hello, Uncle Jim here. One of the greatest ways to make passive income with investing is by selling options. Today, I want to share with you some strategies that have actually helped me boost my income. So stay tuned. I think you're really going to enjoy what I have for you. Okay, let's go ahead and jump in. I typically will do a kind of an update with the market. I'll do a really brief one. We've been kind of down this week. Today, I think we were down quite a bit in the morning and we're maybe up slightly. But we've had some earnings with some specific companies. I think Camping World came out and they disappointed. I think PayPal had good numbers, or they met their numbers, but they kind of had some subscriber numbers that a lot of the market didn't like. So they're down big time today. So I think we're going to have that. The market's pretty unforgiving either way. I mean, if you disappoint, then they're going to hit you hard. But if you have good earnings, I think the same thing is true. You may see the company go up quite a bit in a short period of time. I don't think much has changed interest rate wise. I still think the Fed's going to hold off for a while. And then really, I'm not sure we're going to go into a recession. A lot of people are predicting that we may have a real soft landing or, no recession. Of course, you never know. Things could change pretty quickly. I do know the price of oil is going up, and that has a big impact on everything. So let's jump into the main part of the video. So today I wanted to talk about some trades. So I have some companies that typically haven't done real well. I mean, they've had good earnings. Companies like Verizon and AT&T who have been kind of flat. Even CocaCola has been kind of flat. So this video kind of talks about how you can boost your profits related to dealing with those kind of companies. And it especially is a good time during a sideways market or a slightly up market. So I'm going to talk about those kind of trades. It's primarily due to poor premium. It may be poor covered call premium in the instance of Verizon or AT&T since they've been down so much. And even the CocaCola covered call premium is lacking. So, I wanted to find another way to kind of deal with that since I already own the shares. I don't want them to sit there and not earn me some income, some extra income out there. So what have I done? I've done a new type of trade. I've done it in the past. I've done videos about it, one other video, I believe, and that's the reverse Jade Lizard. And all it is like an iron condor, but without buying the outer call. So if for those of you who don't know what an iron condor is, it's a vertical put credit spread paired with a call credit spread. So you sell a put, then you buy a put at a lower price, then you sell a call, and you buy a call at a higher strike. Now, if you already own the stock, you don't necessarily have to buy that outer call. But if you're willing to buy more of those particular shares that you like the company and you're okay with that, then pairing a covered call on shares you already own with a vertical put credit spread works out really well. And that's what I've done. I've done it with Coca-Cola. I've done it with Verizon. I also did it with Walgreens. Walgreens has been struggling lately, even though their numbers look okay. And I'm going to share those trades at the end of the video, so I'll go into more detail exactly about those trades, how profitable they are, why I made those trades. And so we'll go into a lot more detail with that. But I do want to mention that I always stick to my guidelines. So I still use the same delta, like a 15 delta for puts and a 20 somewhat delta for calls. Now, if I typically like to take a little less risk when I'm doing this kind of a trade, as well as with an iron condor. So I'm going to also share with you an iron condor I did, and I took less risk with it. I think I did 12 deltas on both sides, and I did that with an ETF. Again, that'll be at the end of the video, and I'll go into more detail. But it's really key to stick with your guidelines, stick with the same kind of deltas or risk level you want to trade with. Also stick with the type of expirations you like. Don't suddenly change your guidelines because this is a different strategy. And that's what I've done. So it's really a very similar vertical put credit spread as to what I've done against other companies. And the covered call, same situation. It's at a price that I'm pretty confident that the stock's not going to get called away. Because I really, I own Walgreens and CocaCola and Verizon at really good pricing, and I make good dividends on them, so I really don't want them to be assigned away. And then you also manage it in a similar way. You can actually manage it as its individual parts, because even though it has fancy names, it's always just puts and calls, selling puts, selling calls, buying puts, buying calls. We come up with these fancy names and make it, in a way, more difficult. So I like to keep it simple. So you manage the trades in a similar way. If the covered call becomes way out of the money and very profitable, you can close it and potentially open another one. You can let it expire. If it stays flat and both sides end up very profitable, you can close, both sides of the trade. So I don't want to make it too difficult. Even though it's a slightly more difficult strategy than a covered call or a cash secured put or just a vertical put credit spread, it's a combination of those three. In addition to it, at times, if you're going to do the iron condor, it would be the call credit spread, which, if you're curious why I don't typically do that, other than for iron condors, is I did one a long time ago, and there's a video on it with Microsoft, and I ended up getting in trouble with it, and I took a fairly good loss with it. So I typically don't do those kinds of trades anymore. So I didn't want to go into a whole lot of detail at this point. I find it more worthwhile to go over the spreadsheet and go over the trades in particular. But as always, please subscribe. If you're curious about my memberships, details are below. I'll also have a link if you want to sign up for Seeking Alpha. I use it quite a bit, and I found it very helpful. So that being said, let's jump into the next part of the video. Okay, now I've opened the spreadsheet. This is a spreadsheet that I manipulated just for this video. It's a typical planning worksheet that I provide to my members. And this is the one from this week, minus the positions that I'm working with. The one usually at the bottom are the positions I'm managing. For this video, I primarily just put the specific trades I wanted to talk about in the video, but I still have the stocks that I was recommending. So each week on Sundays, I provide this to my membership, and it covers the companies I'm interested in. It talks about, different strikes, different deltas, how much premium you can expect with one contract, and a little bit about the company. So I typically provide that, but what we're interested in today is down here. So these are the four trades that I wanted to share. The first one is Coca-Cola. This is the first reverse Jade Lizard that I did, and I did this back early this year. It did expire, and it was originally going to expire 6/16, or not going to. It did expire on 6/16, June 16th. So it was the short strikes were 67.50, so I sold the covered call with 67.50. The short put was $55, so I kind of knew Coke typically doesn't hit that 67.50, and it typically doesn't get down to 55. It may get down to 58 or 59. Now that all could change if we have a massive drop-off in the market, but typically that's the case. Then I bought a put on the downside at 45, and I was able to buy that put fairly inexpensive. And the delta for the call was 21, and then the delta for the put was 17.8, a delta of 17.8. So again, taking less risk with the put and maybe a little bit more risk with the covered call. But again, since I understand Coca-Cola, I know typically how they move. It's not that risky in my mind. And again, expiring on 6/16, currently it's at 61.77. It brought in 149 premium. That again is one contract, not two. So not bad for one contract. I needed required margin was 851, and I had a 42.62 yearly return. And that's just simply the premium divided by the required margin adjusted for the year. So, and that worked out really well. I'm definitely going to do more with Coca-Cola. Next was Verizon. This one I just did back last week on July 28th, and it both was out of the money. This one I took a little bit more risk with because I'm okay with earning more not earning more, picking up more Verizon. So the call I did was 38. I think my cost basis is right around that. And then the put I sold was 31, and then the outer put was 22. So I found the 22 put was just the same price as the 21, so I chose the 22 put, which meant the spread was a little bit shorter or less wide, and I didn't need as much capital. And the delta was 24 on both. So this one I did take a little bit more risk. It's expiring on 1/19/24, so a little bit farther out. What is that? More like 5 months. The current price was $33.43, and I think as of today it's still right around there. I brought in $276. Now, just with the covered call, I wouldn't have been able to bring anywhere near as much as that. You can actually see the premium up here. So, yeah, I brought in, I think, 65 on the covered call and 85 on the selling of the put. And then the purchase of the outer put was $10, which was a 22. And excuse me, you'll hear me chewing on something. I've got a really bad summer cold, so I'm trying not to cough in your faces or blow up the volume because of my coughing. So this, I did a 37% return, but again, on someone like Verizon who, I think its dividend is 6 or 7% because it's gone down so much. So I was able to bring in a lot more premium by pairing this vertical put credit spread with the covered call. And I chose 31.22 again because 31 was right near the 52-week low. I didn't think it could go below 31. It might, though. But I'd be okay with owning it at 31 and picking up another 200 shares. So that's for Verizon. Now, this is IWM. This is the Russell 2000. This one I did back in June, and it's an Iron Condor. And this one I did, again, an Iron Condor. You've got the vertical put credit spread and the vertical call credit spread combined. So the short call was 207. The outer call was 217. Then the inner, or the short put, was 169. And then the outer put was 159. So, and this worked out really well. Again, I only did one contract. And it was a 12 delta for both, so very little risk. And I thought really what would happen was that the 169 would be more at play, not the 207. And the reverse has happened. It's the Russell 2000's gone up so much that it actually, I think, got up to 200 at one point. So this one expires on 8/18, which is next week, or 2 weeks. And it was 197. I think it came down in the last day or two. I think it's like 194 now. And for that one, I had 111 in premium. The required margin was 888. So it's a 70% return for that time period. And I did only one contract. Again, I probably need to do more because I've been very successful with the Iron Condors. And IWM, since I use it primarily for cash, I'm a little less hesitant of doing an Iron Condor on them, primarily because it doesn't move as much. If you look at an Apple or a stock that might move really quickly, you could get yourself in trouble one way or the other. It could dive really quick, or it could go up really quick. For instance, today is PayPal. I went from, I think, $73 to $65 in just a couple of hours. So the last one is Walgreens, and this was assigned to me back in October when it was at a real low. And again, I own 200 shares, and I did a three-legged reverse Jade Lizard. Again, the terminology is kind of funny. It's also called a twisted sister, which I don't know why, but if you know why, please add a comment. And for it, the call that I sold was for 35. The put I sold was for 25, and then the put I purchased was for 15. And I did go a little farther out to 119.24. Current price at that time was $29.57. I think it may be as high as 30 now, so I'm still $4 or $5 outside of ending up with more shares. And I brought in 210 in premium. Was this one contract? This may be incorrect. No, two contracts. Oh yeah, so this should be double. This is 210 is correct, but this should be 2,000. So a smaller gain, 20, 25. And let's see, let's look at those 25.15. Yeah, so that's correct. So a 25% return for a stock that really has been hitting new lows works out pretty well. And it's not real risky. It's at 30, it's pretty far from the high part of the call, and it's also pretty far from 25 or the put. So I'm pretty confident that this one will also expire outside the money, or I may be able to close it because it gets really profitable. Now, you may ask, well, why are you going so far out? I get that question a lot. I typically will go farther out. I'll pick lower strikes, and a lot of times I can close them early. So rarely do I let them expire. The one above with Coca-Cola, I did let expire. But I found I can pick strikes much lower if I go farther out, which removes the risk. Back in October when I had some stuff get assigned, I was using a higher delta and I wasn't going as far out. So to me, what's more important is picking the right stock, because again, that's the key. You pick the wrong stock, you can really get yourself in trouble. And then picking it at the right price, knowing what price you want to own that stock. So just wanted to share that. So with these four trades, the average return was 43.84. And again, a lot of these are, some of the poor performers. So to be able to get that kind of a return is pretty surprising. Required capital was 5,052. And then the total premium was 747. So you can really boost the amount of premium you bring in. And I'm going to look at doing more of these kinds of trades because it allows me to also take less risk. So bringing in that extra premium by also selling the put and then buying a really cheap put has really worked out well. So I'll be curious to hear what you think. Please leave a comment below. I typically answer all my comments, so I'll be looking forward to hearing from you. And as always, I hope you have a wonderful day.